Welcome back. We are now moving into chapter 5, which is adjustments and the worksheet. In the last chapter, we learned about the general journal and the general ledger. This is what the general journal looks like after we record transactions. Now remember that the general journal is where all transactions are recorded in chronological order. This is the master record. We also learned that this journal can become massive as more and more transactions are recorded, and it can also become a long process to determine the balance of certain accounts at a particular time. Because the general journal is not so efficient to provide immediate feedback, we learned how to transfer transaction information from the general journal to the general ledger. We basically learned how to record all transactions that relate to a particular account into one general ledger account. And in this visual, we can see how the general journal has a record that affects two accounts, the cash and the owner's capital account, and it also shows you how the information is transferred into the cash general ledger and the owner's capital general ledger. This is what the general ledger looks like for the three transactions that are recorded in the general journal. If you need a refresher on how I got to this point, please review my lecture for chapter 4. We can basically see all transactions related to each account in the respective general ledger, as well as the balance for each of the ledgers. Our next step in the process is the trial balance. This is not the first time that I introduce you to this concept. I briefly introduced this to you in chapter 3. Basically, the trial balance provides an overview of each balance for each general ledger. Think of this like your bank accounts. You receive monthly statements that show transactions for your checking and your savings accounts, and these statements typically separate all transactions for the checking account and the saving account and show a balance after each transaction that you make. No matter if it's a purchase or paying for bills or receiving money back when you return an item, you will see a balance after each of those transactions. This is just like the concept for the general ledger. You record all transactions related to a specific account in one general ledger. Now, we also have access to our bank account information online. And when we log into our bank account, we are usually directed into the main page that may show you the balance for the checking and the savings account. You don't see all of the transactions that relate to each account on this page. All you see is the balance or the amount of money that you have in the checking or the savings account. This is similar to what the trial balance is. This is a place where you transfer all the balances from each of the general ledgers. The difference here is that we record the balance as a debit or as a credit, depending where the balance is recorded on the general ledger. Now, to show you how I transfer this information, I'm going to split the screen to show you 2 slides at a time. And I hope that this is big enough for you again. If not, you could download my PowerPoint slides so you could follow. So what we see here is the balance for the cash general ledger, which is $19,000. And this is from the example that I covered in the last chapter, chapter 4. As you can see, this is a chapter 4 PowerPoint. And what we will need to do is transfer this balance on either the debit or the credit side onto the trial balance. In chapter 2, you learned that you determine the balance of the debit and the credit and then take the difference and record the balance on the side that has the largest amount. For the cash general ledger, we have a total of $30,000 on the debit side and a total of $11,000 on the credit side. And if we find the difference between these two, it's $19,000, and we record this on the debit side since the debit side has the largest amount. So we know that the balance for the cash general ledger is a debit of $19,000. This is what we will transfer into the trial balance, as you can see here. Okay? And we record the cash account as a debit of $19,000. We are going to repeat this process for the remaining general ledger accounts, but the order that is going to be recorded is going to be a little different. What we need to do is record each balance for each account by following the accounting equation. We know that the accounting equation is assets equals liabilities plus owner's equity. So what we are going to do is record all of the assets first, then we're going to record the liabilities, then owner's capitals, then owner's drawings, then revenues, and then lastly expenses. So if we follow this process, we will eventually come up with a trial balance on this slide. Okay, we have the assets first, cash, then equipment, then supplies, and I'm only transferring the accounts that you see here on the general ledgers from last chapter, okay? If there are different accounts, then we need to transfer those accounts here as well. So only the ones that are here. So we have cash, equipment, supplies, and then we go into liabilities, which is accounts payable, and then we go into owner's capital. And if we had owner's drawings and revenues and expenses, then we will list them right after that. And we list them as either a debit or credit, depending on what we determine here in the general ledger. And the last step is to add each column for the debit and the credit to ensure that both columns balance. Remember that if they don't balance, then there's an error in the process. Okay, so let's go back to a full screen. Now, let's talk about adjustment or adjusting entries. Even though we are recording every transaction in the general ledger, there are some transactions that arise once the time period has ended or the accounting period has ended, which may require that you record an adjustment. Journal entries that are made to update the account for previously unrecorded items are called adjustments or adjusting entries. And we will learn in a few slides about the worksheet, what we call a worksheet. The worksheet provides a convenient form for gathering information in one place, and that is where the changes are entered at the end of each accounting period. So we have two types of adjusting entries. We have deferrals and then we have accruals. Deferrals are for transactions where you prepay expenses or when your business receives cash before services are performed. And accruals are for transactions known as accrued revenues and accrued expenses. Accrued revenues is when your business performs services but has not received payment for those services, and accrued expenses is when expenses are incurred but not yet paid in cash or recorded. Here's another best friend for you that you can refer to when completing your homework. It basically tells you if you should debit or credit When dealing with certain types of adjustments, we have prepaid expense, unearned revenues, accrued revenues, and accrued expenses. These are the type of adjustments. And the middle column gives you an explanation as to why the adjustment is needed. And it can be for two reasons, as you can see here for the pattern. It can be for two reasons, and that is because the account can be overstated or understated. And here's where it tells you how to adjust it by doing a debit for expenses or an asset and crediting assets if it's for an adjustment dealing with prepaid expenses and so on. Now, to explain adjustments in more detail, I will present to you a few examples that deal with these accounts. And once I cover adjustments, I'm going to move on to the worksheet, what we know as a worksheet, to show you how to gather all sorts of information in one location and then show you how we can use that information to complete the financial statements. Our first example is when the business has prepaid for an insurance policy. Think of your vehicle or your home mortgage insurance. We can decide to pay it monthly or we can pay for a period of time. It could be 6 months or a year in advance. And so what this example is showing you is that the business has paid $2,000 worth of insurance policy. In other words, the business paid this amount in advance. It doesn't specify how many months in advance, so it can be for a few months. It could be for different periods. What we do know is that the insurance expires at a rate of $300. What this means is that the cost per month for this insurance is $300. Now we can easily determine how many months were paid in advance with this information, but that is not what we are here to learn today. What we are here to learn is how to make adjustments. So why do we have to make an adjustment? Well, if at the end of the accounting period, in this case is at the end of the month, if we don't make an adjustment, we would leave the prepaid insurance account with a balance of $2,000, but this will only overstate the account because we know that the insurance company charges $300 per month for that policy. So we no longer have $2,000 worth of prepaid insurance after 1 month has lapsed. What we need to make or do is we need to make an adjustment to reduce the amount in the prepaid insurance by $300. And we need to do that so that the account now reflects $1,700 versus the $2,000. And so we do that, and we determine that in order to increase the insurance expense account by $300, in order to record that the insurance now has expired 1 month of prepaid insurance. So what we do here is we debit the insurance expense by $300 and then we credit the prepaid insurance by $300. Remember to always explain why you're doing this transaction, and in this case is to record the insurance that has expired for 1 month. Now, you will also deal with this type of adjustment, which is dealing with supplies. What this example is showing is that at the beginning of the month, we have recorded a total of $2,000 worth of supplies. Now remember that we are dealing with a business. So if the business has supplies, then they have them because they need to use them. So let's say that the supplies are beverage containers for a restaurant. You know that those containers are going to be used throughout the month to give customers beverages to go. So, what the business has to do is take inventory every month to determine how many containers are left and determine the value of that inventory. This example is telling us that at the end of the month, it was determined that only $1,000 worth of containers are on hand. So, in other words, the business used 50% of the inventory for that month. So, we have to make an adjustment because if we don't, we are going to overstate the amount of supplies on hand. And the supplies expense account is going to be understated. So, to make this adjustment, we debit the supplies expense account in order to increase that account and um, and record the amount of supplies that have been used. And then what we have to do next is credit the supplies account in order to subtract the amount of supplies that are now on hand or available to the business. And we are done with this adjustment. We just need to make sure that we describe what this adjustment was for, and that's to record supplies used. We also deal with depreciation of equipment. Your business may buy a computer, for example, that you know will last about 3 years or so, and you know that the value of the computer will depreciate every year. Well, we need to record this as an adjustment because if we don't, we will be overstating the real value of that computer. And what this example is telling you is that at the beginning, um, what it's telling you is that the equipment that was once worth $34,000 when you first purchased it is depreciating at $400 per month. So to adjust this, we um, we debit the depreciation expense in order to reduce the value of the equipment by $400, and then we credit the accumulation depreciation to record the value of that depreciation. And then we describe what this transaction is for, which is to record depreciation, and you're done with the adjustment. The last type of adjustment is when we are dealing with unearned revenue. And this is when the business earns cash for a service that has not been completed or delivered. But eventually, the business will deliver for that service or for what that promise was. So we need to adjust this because if we don't, we will be overstating our liabilities and understating our revenues. So we do this by debiting unearned revenue or unearned service revenue and by crediting the service revenue account, and that description will be to record revenue for services provided. This is telling us that we no longer owe that service, we have earned that cash or that revenue. Now, let's move on to the worksheet, which is going to be the bulk of the homework assignment for this week. This is the place where we can gather lots of information and use it to eventually complete the financial statements. I am taking this information straight from your textbook, so you can go back and refer to that. We are going to begin with the trial balance. Remember that this information is taken straight from the general ledgers for each account. We basically transfer the balances and record them as a debit or as a credit, depending on where the balances for these accounts are recorded in the general ledger. After entering all of the balances from the general ledger, we need to foot. This is a new term for you. I'm little by little introducing you the accounting lingo. We need to foot the columns in the trial balance section. And to foot a column means to add the numbers in that column. Remember that they must balance before moving to the next set of columns. When you ensure that the debits equal the credits, you are ready to place a double rule underline under the trial balance columns to show that the work in the column is complete. Notice that the next section of the worksheet is the adjustments. Okay. Here we record any adjustment that you may have to record. So as you can see in this example, we have adjusted the supplies account. Here's the adjustment for $500. The rent expense. The prepaid rent expense account. The depreciation of equipment. The supplies expense. The rent expense, and the depreciation expense account. Those are the accounts that were affected with the adjustments made for this example. This is similar to the examples that I provided to you previously, except that this is the examples provided in the book. So what we do here is transfer that information into this column, into these columns, as either debit or credit, depending on how the transactions were recorded when you made the adjustments. And once the adjustments are recorded, then we add the columns for debits and credits to make sure that they are balanced. Now we move on to the next column, which is the adjusted trial balance section. This is where we do horizontal math and combine the first set of columns with the second set of adjustment columns. And we see here that the cash has no adjustments. It's blank here under the adjustment columns. So its balance carries over to the adjusted trial balance. The same with accounts receivable and so on for those accounts that have no adjustments. Our first account which has an adjustment is supplies. Okay. It started with a $1,500 debit balance, and then we credited for $500. We carry the new adjusted balance of $1,000 to the adjusted trial balance section. And the second adjustment was to record the expired rent. Okay? And the third was for depreciation. And after each one, the new extended total is carried over to the trial balance, to the adjusted trial balance column. Now make sure to foot the columns of the adjusted trial balance section to ensure that they balance, okay? Otherwise you know that there's an error, something went wrong. Now, we move to the final steps of completing the worksheet. And this is to transfer the accounts which belong to the balance sheet to the balance sheet section. And only assets, liabilities, and the owner's capital account belong to the balance sheet. And revenues and expenses belong to the income statement. The only exception to this rule of balance sheet and income statement is the drawing account. Okay, this account, when included in the adjusted trial balance, is moved over to the balance sheet section, even though it doesn't show up on the statement. Rather, it shows up on the statements of owner's equity. Okay, after all the balances have been transferred, foot the 4 columns and notice that the totals of the last 2 sections, income statement and balance sheet, do not balance. So let's go on to the next slide to try to explain to you. Okay, focus on the income statement section and subtract the smaller column total from the larger column total. You will notice that the totals of the columns do not balance. The difference is considered the net income or the net loss. Well, for Wells Consulting Services, which is our example that we're working on here, they had $33,667 of net income for the period. Okay, you place this amount in the debit column so that both of the income statement columns now balance. And then you place the same amount of $33,667 in the credit column of the balance sheet. Sorry. Hold on. So, you place it on the same amount of $33,667 in the credit column of the balance sheet section. After doing this, the 2 columns of the balance sheet section will balance, as you can see here. This has the effect of adding the net income to the owner's capital account. And notice it's on the credit side of the balance sheet section. Okay. All right, we're almost done here. You can see that the footed columns of the income statement and the balance sheet are now balanced. Okay, so our fourth objective, or our last objective for this chapter, is that we must prepare an income statement, a statement of owner's equity, and the balance sheet from the completed worksheet. This is where that worksheet, this one here, is going to come in handy because you have everything in one spot that you need. You have the trial balances, you have the adjustments. From here, you could actually come up with a new adjusted trial balance. And based on that, then you transfer the information for the income statement. Remember, income statement is for revenues and expenses. And for the balance sheet is for the assets and liabilities and owner's equity. So our last step here is that we need to prepare an income statement, a statement of owner's equity, and balance sheet from the completed worksheet. And what we do is use the income statement section of the worksheet for the amounts to carry to the income statement. You can see that the income statement is now easy to prepare. It's just a matter of transferring the numbers over into the proper income statement format. Okay, so now moving on to the statement of owner's equity. Remember that statement of owner's equity reports the changes that have occurred in the owner's financial interest or the owner's capital account during the reporting period. So here is the statement of owner's equity for Wealth Consulting Services based on your textbook. And the beginning capital balance came from the unadjusted trial balance column, and the amount of net income came from the worksheet. And if you don't remember any of this, remember on my last slide, on my last lecture from the previous chapters, I provide to you step by step how each of the 4 financial statements interrelate with certain information. And in addition to the account form of a balance sheet that was previously used in Chapter 4, there's also a report form of a balance sheet, which shows the balance sheet data in a vertical format. So in actual practice, the report form is used most often. And here it is. This balance sheet has been prepared using a report form format, and all accounts, both assets and liabilities and owner's equity, are listed. And this is it. This is it for this chapter. As you can see, what you have been learning from the past few chapters are coming together to come up with more complete information in one spot versus having different records in different places. So I am moving on from going step by step, detail by detail, to explain to you these concepts because I have explained them to you in previous chapters. This is just making sure that everything's coming together for you to see how all this information can be gathered in one spot and how we can use that to transfer it to come up with the financial statements. So if at any point you need a refresher, just go back to those lectures to see how all of these statements are related and how we take certain information from certain aspects of the financial statement to come up with certain fields of other financial statements. And if you have any questions, please let me know. And just make sure that you complete your homework assignments and including the reading of the textbook. And let me know how I can help you. Thank you for your time.